Welcome back to FX Limit. If you've ever felt lost in the sea of news headlines and economic reports, wondering how to make sense of it all for your trades, you're not alone. Today we're breaking down the top 5 fundamental analysis strategies in Forex trading that actually work, especially if you want to trade smarter, not harder. Let's get into it. First up, interest rate differentials. This one is huge. Central banks use interest rates to control inflation and stimulate the economy. When one country's interest rate is higher than another's, traders flock to that currency for higher returns. For example, if the Federal Reserve raises rates and the European Central Bank doesn't, you'll likely see the USD strengthen against the euro. Tracking these differences helps you predict potential currency movements and ride the trend early. Keep an eye on central bank statements and economic calendars to stay ahead. Second, inflation reports. Inflation is the silent currency killer. If a country's inflation is too high, the central bank might raise interest rates to cool it down. Conversely, low inflation might push rates lower. Key reports like the Consumer Price Index, CPI, give you a direct view of this. When you see inflation rising faster than expected, expect market volatility. Traders who position themselves before these announcements often get the edge. But remember, it's not just the numbers, it's how they compare to forecasts. Third on the list, employment data. The labor market says a lot about an economy's health. Non-farm payrolls in the US is one of the most watched reports in the world. Strong employment growth usually means economic expansion, which is bullish for that currency, but a surprise drop? That could sink it fast. It's not just about the headline number. Look deeper into wage growth, participation rate, and revisions from previous months. These small details often drive big price moves. Fourth, trade balances. A country that exports more than it imports has a trade surplus typically positive for its currency. A deficit, on the other hand, might weaken the currency over time. Countries like Japan often see their currency gain strength because of consistent surpluses, while others with persistent deficits struggle. This is especially important for longer-term traders who are looking to align with macroeconomic flows rather than short-term price action. And finally, geopolitical events, political instability, elections, wars, or even global summits can shake the Forex market. When uncertainty rises, traders often move their money to safe haven currencies like the USD, CHF, or JPY. Learning how to interpret news and anticipate market sentiment around these events is a skill that pays off. You don't have to be a political analyst, just stay informed and watch how the market reacts in similar scenarios. Now, here's the thing. Fundamental analysis is powerful, but combining it with technical confirmation is where the magic happens. That's where tools like the Apex Trend Indicator come in. Even if you've got the fundamentals right, you still need accurate entries and exits. This indicator helps you visually confirm trend direction with zero repainting, giving you more confidence when placing a trade based on economic data. It's like having a second pair of eyes watching the market for you. So whether you're trading interest rate decisions, reacting to NFP reports, or anticipating a geopolitical shift, you want to make sure your technicals align with the story. That's how you stack the odds in your favor. If you found this breakdown helpful, make sure to check out more tools and insights at fslimit.com. Catch you in the next video.